Hey, it's Darius. And once you start using I-75 CPA review, you're going to be looking forward to score release day as much as I do. So congratulations to all those I-75ers who recently passed the CPA exam. If you didn't pass, don't get mad. You might just need to get on a better road. So get yourself on I-75 because the right teacher makes all the difference. Now let's take a look at temporary differences that result in tax deductions this year, book expense next year. Depreciation is a common source of temporary difference between financial reporting and tax reporting. Why is book income often not the same as taxable income? Because companies use different methods for calculating depreciation for financial reporting purposes, GAAP rules, versus depreciation under the IRS rules. For financial reporting, companies regularly use straight-line depreciation, which allocates an equal amount of depreciation expense over the useful life of the asset. But on the tax return, companies use makers. And for certain assets, that allocates higher depreciation deduction in the earlier years of the asset's life, and then lower deduction in the later years of the asset's life. And that's what you'll bump into on the exam, the fact that they're going to use straight line for book purposes, but for tax purposes, they'll use something like double declining balance. And the exam will ask, how does that determine whether you have a deferred tax asset or deferred tax liability in the first year of the asset's life? Here's an example. Company buys a $50,000 asset with a 5-year life. For book purposes, it will be depreciated straight line for 5 years. So for the books, the expense will be $10,000 per year. 50,000 divided by 5-year life. Assuming that book income is 100,000 before depreciation, then your book income would be 90,000. 100,000 minus the 10,000 of book depreciation. So book income 90,000, but that same asset, which costs 50,000, is also going to be depreciated for tax purposes. 50,000 is the cost, but for tax purposes, they'll tell you to use double declining balance, and that they got 20,000 of double declining balance depreciation the same year they got 10,000 of book depreciation under straight line. So then for taxable income, we would start with the book income of 90,000, add back the 10,000 of depreciation taken on the books. So now you're back to the 100,000. Then subtract the tax depreciation of 20,000, and taxable income is 80,000. So in this current year, the year the asset is purchased, taxable income 80,000, book income 90,000. The tax rates in effect they'll have to give you. Current year 20%, future years 25%. Then they'll ask for the current tax expense. Well, you would take taxable income, 80,000, multiplied by the current year tax rate, 20%, and 16,000 is payable right now for this year in income taxes. So current tax expense this year, 16,000. But we then have to take the $10,000 difference in depreciation, the 20,000 taken in the tax return minus the 10,000 taken on the books, and multiply that $10,000 temporary difference by the future enacted rate, which they told us is 25%. So the deferred tax is $2,500. Now, is it an asset or is it a liability? Well, we saved taxes this year because our taxable income was lower than book income, but when this difference reverses, then the taxable income will be higher than the book income. And in that future year, when the difference reverses, we'll have to pay more tax. So let's record that liability now. What are the journal entries for the current year? There's actually two. The first one is for the current tax expense, and that's based on the taxable income this year, 80,000, times the current tax rate of 20%. And that gives us 16,000, which is what we owe the IRS right now. Debit income tax expense current, credit income taxes payable current, 16,000. For the deferred expense, that's based on the temporary difference of the depreciation methods. That's $10,000 difference times 25%, the future tax rate, which is $2,500 more of income tax expense and credit income tax payable. Notice that the $2,500 is not owed now, it's owed later, so we'll debit income tax expense deferred $2,500 and credit income taxes payable deferred $2,500. Then the exam will ask, what's the total income tax expense on this year's income statement? And for that, you would add the two expenses together. The current expense of $16,000 plus the deferred expense of $2,500 gives you total income tax expense of $18,500. Different depreciation methods caused the temporary difference, which resulted in a DTL. And in the year of a DTL, we paid only $16,000, but we expensed on the income statement $18,500. DTL will always result in expensing more in the current year income statement, $18,500, compared to the taxes paid in the current year, $16,000. Let's try this. For year one, a company's financial statement depreciation is $14,000. Its tax depreciation is $24,000. The tax rate is 20% in the current year and 28% thereafter. What's the current tax liability for year one if book income is $60,000? So what do they want? They want the current tax liability. What's owed right now? For that, we need to calculate taxable income of the current year. And they didn't give us that. They gave us book income for the current year of $60,000. Now, which one of these two depreciation figures were subtracted to arrive at book income? The $14,000, because it says the company's financial statement depreciation is $14,000. So when they did their income statement, they subtracted $14,000 of depreciation to get down to book income of $60,000. So the first thing we have to do is add that back. Add back the $14,000. Then we can subtract the $24,000 of tax depreciation because we want taxable income. So taxable income comes out to be $50,000. And then we multiply that times the 20% current year tax rate. So the amount of current tax liability for this year is $10,000, and that's letter A. And the journal entry would be debit income tax expense current, $10,000. Credit income taxes payable current, $10,000. This question asked for the current tax liability for year one, and the answer is $10,000. All right, similar facts, but now they want the deferred tax liability at the end of the first year if book income is $60,000. So deferred tax liability is based on the temporary difference. The depreciation methods created a $10,000 temporary difference, and for that we'll multiply by the 28% future enacted tax rate. And the answer would be $2,800, letter A. For the deferred tax liability, we want the temporary difference, $10,000, times the future enacted rate of 28%. We'll debit income tax expense deferred, $2,800, credit income taxes payable deferred, $2,800. And you can probably guess what's next. Now they want the total income tax expense for year one. There's really nothing new to calculate. We just have to determine if we have income tax expense that's greater or less than the amount paid. And if you think you know how much the total income tax expense is, leave me the answer in the comments section. And remember to like and subscribe. And if you need more help with accounting for income taxes or any part of the CPA FAR exam, go to I75CPAreview.com and get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference. Hey, it's Darius, and so much effort and energy go into each I-75 video. But it's all worthwhile when you pass and notice the I-75 difference. Congratulations to everyone who passed the exam in 2024. Get yourself on I-75 because the right teacher makes all the difference. Another incredible score release here at I-75 CPA Review. So congratulations to Kevin for passing FAR, and what a nice score there, an 88. And to all the I-75ers who let me know that they passed in April and May.